Frederick, hello and welcome to Trade Finance Talks TV.
Good morning.
So if we can start off with, who are you, where are you from, and what do you do?
Thank you. My name is Frederick Bourgeois. I'm the Managing Director of CoFace in the UK and Ireland. My background is capital markets and reinsurance. I joined CoFace 15 years ago, and I've been the Managing Director in the UK for the last 7 years.
Okay. So what's the role of insurance in the context of receivables finance?
Well, part of the role actually doesn't have to deal with insurance per se, but with what the underlying condition for insuring businesses, which is the provision of information. So we do support our clients who are invoice finance companies with the provision of information to help them source new business, originate, and also just manage data, because we are a massive provider of data. The insurance business actually relies on data fundamentally. And then there is the pure insurance part, which is providing cover so that some invoice finance companies can gain some form of capital relief. Some others will just insure because they want to manage their counterparty risk or their credit risks, and they rely on insurance to take the excess risk which they do not want to be on their balance sheet. Mm-hmm. So effectively, it's two things on the insurance part. It's capital relief and really pure credit risk.
Okay. So at a high level, what is securitization and where is this used?
Securitization at a high level is very much taking assets from the balance sheet, which would be sitting idle otherwise, and making sure these assets are put in a vehicle, pulled together, and as a collateral effectively for financing. And usually the traditional structure means these assets are purchased by a special purpose vehicle. The special purpose vehicle then will issue notes to conduits, and these conduits are placed in the commercial paper market. And this is a very cheap and efficient way of financing for corporates generally.
Mm-hmm. Are specific policies required for securitization, and if so, why?
Usually what we tend to advise to our clients is to have a base policy and an SPV policy, and the two being linked, which means that the same credit limits can be applied across the two policies, which means that our clients will choose which invoices they want to send to the vehicle, for which they will get a refinancing, and which invoices they can keep without any form of financing, and they can play at all times between what they want to finance and what they don't want to finance. So that's one of the main I would say specifications for securitization. Mm-hmm. And after that, there's a few others, but which completely depend on the client, the location or the jurisdiction, and a few other bits. It's on a transaction per transaction basis at the end.
Mm-hmm. How do insurance policies differ on different types of receivable structures?
They tend to differ with securitization on one aspect, which is that there cannot be any form of operational risk taken by the funders or the funders ultimately. So they necessarily have got some levels of cure periods in there, which means that contrary to the traditional mechanisms of credit insurance, the funders can always step in and remedy any form of breach by the sellers or the seller of the underlying receivables. Other than that, it's really, as I mentioned, on a transaction by transaction basis. There's no specific rule, and we will adapt ourselves to the conditions of our clients ultimately.
Mm-hmm. And what changes have you seen in the receivables market when it comes to different types of insurance and also securitization?
Oh, recently, it's mostly linked to pricing. What is very interesting is that pricing levels are not necessarily even across the globe. So we will tend to see some fairly significant differences between geographies, which would be surprising at first sight, but this is also a reflection of how much securitization has been used in the past and is established as a tool. And so this drives, ultimately, competition. Other than that, the main differences would tend really to be linked to geographies, jurisdictions, applicable law, etc. Not so much on the underlying process itself, and more around the conditions to adapt a structure to a specific company.
Great. Frederick, thank you for joining us on Trade Finance Talks TV.
Well, thank you very much